Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit. My name is Alex Mathew. Now, what we normally do on the show is bring you concepts that you can understand in the mutual fund space, and we give you actionable insights so that you can take your investment decisions with confidence. Now, we normally discuss one or two topics, but there's so much happening in the space of late, so we decided to take a number of topics today. Among them, incremental investments in mid-cap and small caps. What should you do with them if you get a large amount of money towards the end of the year, as quite a few of us do? For example, if you've got your reimbursements that have piled up over the course of the year, and like me, if you're claiming it's not efficient, but like me, if you're claiming towards the end of the year, how do you deploy that if you're saving about 40% of it, which is a good practice to have? If you are looking at thematic funds, if you're looking at sectoral funds as a tactical allocation, where should you look? Is an SIP approach the right way to invest in these thematic funds? That's something that we'll discuss today. Overnight, or rather last evening, there was also an announcement or a message that was sent out to mutual funds about investments of funds into overseas ETFs. Those are going to stop, inflows are going to stop from the 1st of April. If you are planning on investing in some of these schemes, what should you bear in mind if you're looking for a slice in the overseas equity pie? So all of those aspects are what we're going to discuss today. We're joined today by Himanshu Kohli as well as Amol Joshi. And thank you so much, gentlemen, for taking the time as always, and pleasure having you on the Mutual Fund Show. I'm going to start with the first conversation, which is, and I know that it's been spoken about quite a bit in the recent past, but we have to talk about it, mid-cap and small-cap investments, but incremental investments. A lot of people receive money towards the end of the year. How should they deploy it? So the big question I think that I'll start with, Himanshu, is what are you advising your clients to do at this juncture when they're talking about their incremental investments?
So Alex, as we all know, mid-cap and small-cap have had a good run in last 12 to 24 months. In fact, today when we see the valuation of this, it is almost 2 standard deviation above what it should be as a ratio to the large cap. So last few months have actually taken the valuation up. And today, a lot of people, they are seeing the recency bias of mid and small cap, and they are moving towards it. While our advice is actually contrarian, and we are saying don't put any fresh money into mid and small cap. In fact, if you are overexposed, sell it and move it to either asset allocation funds or maybe towards a large cap, but don't put any fresh inflows into mid and small cap funds. So the fresh money we are recommending to go into asset allocation funds, which have huge advantages because they can actually protect you while there is a downside which is happening. And when the upswing happens, you can also get the positives of that upswing. And also the fund manager has the flexibility to move the equity portion to a more large cap companies over there. So this is something which we feel is best at this point in time. In case you have any scope for growth in your portfolio, at this point in time, prefer for a conservative growth, which is coming through asset allocation funds.
Before I go to Amol with the same question, I want to elucidate that point that you made on standard deviations just a tad bit. You had, in fact, sent us a couple of charts, and I would request my producer to put them on the screen. For those that are not statisticians and those that don't understand standard deviation, why is this significant, Himanshu?
Because standard deviation, Alex, is a measure of risk, volatility. So higher the volatility, the higher the risk. So if you see today, they are trading at a huge premium compared to a large cap. I do not know if you can just put up the graph over there. I'll be able to explain it through that graph.
So it is. I don't have it, Himanshu, so we'll have to just explain it with the numbers.
Okay, so today there is a higher volatility which is attached with mid and small cap funds. And since there is a higher risk premium which we are paying for it, it's better not to consume it. It's something like this. So let's say if your cup of coffee cost me $100, but all of a sudden the price goes up to 150 because of huge demand which has come up. Maybe rather than having 2 cups, I will restrict it to 1 cup or reduce the consumption. Same is the case with mid and small cap. Today, the price earning ratio of this has actually become very expensive. So I'm paying a higher price to consume a mid cap or a small cap stock. So I should ideally consume it less. That is something which is this model actually talks about. So if you see this blue line, that's the ratio between a large cap and a small cap historically. That's the historical ratio. So today, if you see this yellow line, it is actually at the two levels above this, which is the higher standard deviation, which is what we are paying. And if you see historically also, there are 3 or 4 instances when it has touched 1 or 2 standard deviations. And if you would have bought it at that point in time, there's a huge downside which happens immediately after that. So this is the period which is
caution is advocated, and that's essentially what you've pointed out. Amol, do you have a similar view? And incidentally, this morning I was looking at a notification from the largest small cap actively managed scheme, Nippon, which has put further restrictions on inflows. They've said now 50,000 rupees incrementally for fresh applications of SIPs and STPs is the limit per day per PAN. And they've also said that the exit load of 1% is now applicable if you sell units within 1 year, which is quite significant.
Right. Hi, Alex. Good afternoon. Thanks for having me over on the show. So to answer the first question, yes, my view would be similar because there is no arguing with valuations. It's a no-brainer actually that if you buy any asset at an inflated or at a premium sort of a valuation, you will make money only when valuations further improve or earnings improve drastically. Now, if you are a believer in any of these two, and it looks difficult, it's not to say that this segment, mid and small caps, will really crash from here, but do not go or enter in mid and small caps with the kind of returns expectation that you have seen over last 3 years CAGR or even for last 1 year. Something very important, Alex, in your question, I liked what you have asked me. You are speaking about incremental flows. Now, incremental flows simply means that you already have an existing asset allocation, or rather existing allocation towards mid and small caps. Incremental flows always should be decided upon the factors like what's the kind of asset allocation that you started with, and with the great run-up that we have seen overall into equities as well as mid and small caps, if there is a place to tweak that allocation. If the mid and small cap exposure is beyond what your asset allocation permits you, then obviously incremental flows should not go into the mid and small cap segments. Not last but not the least, additional point over here is you should not decide your investments based on the recent news flow or the narrative. Why we are talking about it is regulatory entities have been highlighting about the froth, so to speak, in mid and small caps, and the funds have responded by giving out some restrictions in terms of exit load and in terms of the restriction of fresh inflows or placing some limits. This is a part of a news flow. News flow should not decide your investment strategy. What should decide your investment strategy? It is your investment horizon, it is your risk appetite and your asset allocation.
Okay, so speaking of risk appetite, that takes me to the next aspect, right? So we've spoken about incremental flows, and both of you have said that you need to be a little bit cautious. That's the sum and substance of what you've said so far. But what about if you've gone a little overboard? And there are quite a few people that have piled into both small caps and mid caps, and particularly small caps. If you just look at the flows, you're talking about over 40,000 crore over the last 1 year, and most of those are retail investments, right? So, Himanshu, the question to you is, how do you identify how much risk you currently have in your portfolio? Because I've had a few conversations over the past few weeks with individuals, and I've asked a simple question: are you comfortable with the market fall or your portfolio falling 50% tomorrow? And the answer was a very vociferous no, absolutely not. So how do you understand if you've got too much risk in your portfolio?
So, Alex, there are two R's. One is the return aspect, second is the risk aspect. So risk profiling is extremely, extremely important for any investor. Let's say we talk about a moderate profile who has a 50% growth portfolio, which is, let's say, equity side, and 50% which is a more preservation portfolio, which is fixed income side. Today, if we see this, most of the clients, they are higher than 50% because last 12 months, equities have done better. So one logic which will come on the basis of risk profile is fresh inflows which are coming in, I will not add more towards equities. Rather, I will move more towards fixed income so that I can rebalance the portfolio to 50-50. There is also, this is all called as rebalancing, but there is a concept called as reallocation, which is nothing but saying if something is expensive, consume it less. So today our model, which is basis the price earning, the yield gap, price to book, market cap to GDP. On this four parameters, we arrive at what should be the strategic asset allocation. So today against 50%, our model is saying we should be somewhere about 43%. So maybe fresh inflows will go more towards fixed income or other asset classes and less towards equities, or maybe I need to sell some equities. And within equities also, let's say for historically or our base allocation towards mid and small cap is 25%. Today, our model is saying we need to be 15% over there. So if I have to do some profit booking, I should do it from the mid and small cap. If I have to add something more towards equities, I should add it towards the large cap side. Or if some fresh inflows are coming, I should build up my fixed income portfolio. So that's the concept which we follow. And it's very, very important in the short run. This risk profiling will go against you because today, let's say if someone does it and markets still see some run up happening, you may feel that you are missing out. But over a complete cycle, you will see the advantage of this whole strategy. There is a concept called as process alpha, which can be created by doing this dynamic asset allocation within each asset class also, not only at the broader asset class level, but even in the asset class across large cap, multi cap, and mid caps. One can actually apply this pure mathematical tool, which is as boring as possible, but it creates an alpha, and most importantly, it reduces the risk which we measure in terms of standard deviation.
Okay. So to add to that then, Amol, we're talking about a situation where people have to book profits, and the FOMO aspect, which we've spoken about in respect to so many investments over the past 3 years, whether at one point of time during the COVID pandemic, it was Bitcoin, which has come back over the last few months as it has hit fresh record highs, and people have said, have I missed the bus, and therefore where do I buy Bitcoin? I don't think that answer or that problem goes anywhere. So how do you identify and fix problems in your portfolio as of now? Do you suggest, as Himanshu has suggested, moving incrementally more towards fixed income? We're talking about aggressive hybrid and hybrid in just a bit, but how do you correct problems in your portfolio right now?
Right, there are 2-3 ways of correcting the problem. The top of the mind, you can say that, see, you always start investing with certain assumptions here in your mind. Those assumptions are related to what would be your future expenses, what would be the inflation, what would be your investment, be it via SIPs or be it via lump sum going into next 5 years, 10 years. Similarly, there is one more assumption related to the kind of returns that you expect from the market. Now, if the market has front run a large distance and you have got maybe 2 or 3 years return or a 6 years return in 4-year time frame, that's one good aspect, or that's one very good indicator that will tell you that you should be able to book the profits. But I also want to go to the heart of your question. You have asked, how do you determine if you have too much risk in your equity MF portfolios? If you are exposed, there is again a simple thumb rule for this. If you are exposed to more than 60%, 60, 80, 100% going into any one segment, be it only mid caps, be it only small caps, be it only thematic. Now, this is the time when you have been hearing a lot about, a particular theme, be it IT. Few months back, or maybe a year and a half back, it was about the international investments. If you are exposed to any one theme or any one corner of the market for more than 60 or 80% of your portfolio, that's again another very good thumb rule that tells you that you are taking too much risk. Last but not the least, Alex, I agree with all your friends who told you, absolutely not, I'm not comfortable with 50% loss or downside in my portfolio. I don't know a single person who says that I'm okay or I'm looking forward to 50% sort of a correction in my portfolio. And that's why booking a realignment of your portfolio in line with your asset allocation. This is what it will automatically book profits from your equity. Obviously, today I will talk about equity because equity markets have given anywhere between 20 to 35, 40% sort of a CAGR over last 3 years. So essentially, when you do the asset allocation goal-based rebalancing, you will go out of equity and to more conservative to moderate asset classes like pure fixed income or even equity hybrid or balanced advantage funds.
Himanshu suggested that perhaps you can look at hybrid strategies going forward, and perhaps you should be a little cautious when it comes to your investments into mid and small cap funds. Let's find out what he thinks about aggressive hybrids as a strategy, or whether you should go towards the dynamic asset allocation route. Himanshu, what's the view here? Can it form a substantial portion of an individual's portfolio? What are the factors to bear in mind?
So first of all, Alex, hybrid is a product, or aggressive as balanced funds are a product for moderate profile investors and who also have a 3 to 5 years kind of a time horizon. So it's a product which is very suitable for them. In fact, it's a very, very efficient product because what it does is it keeps on rebalancing the portfolio. So if the markets run up the way they have run up in the recent past, they'll book some profits and move into more of debt. And similarly, if there is a bear turn which comes and market falls, they will use that cash or fixed income, sell that and buy equities. Now, a lot of investors, they say, why do we need a fund manager to do this? We can do it on our own. But I think that's the greatest myth. Even HNIs or UHNIs, in spite of having the best of advisors, sometimes they are not able to do this either because of inertia or because of emotions which comes into picture. And sometimes there are realistic issues around taxation, exit loads. So these are basically various deterrents. While in an aggressive hybrid fund, if the fund manager sells it, there is no exit load, there is no taxation which they have to pay because mutual funds enjoy the tax benefit over there. So I feel any client's portfolio, a part of your growth portfolio can be through hybrid funds. They could be categorized further into aggressive hybrid or asset allocation funds. And in today's scenario, where we are seeing an overvaluation in the market, maybe an underconsumption of pure equity funds and an overconsumption of asset allocation or aggressive hybrid funds is something which we recommend to our set of clients.
Quick follow-up, and this is not asking you for a recommendation, but which particular fund houses have you liked in the past when it comes to these hybrid options?
So I would say one needs to create a model portfolio, but someone who has been very consistent in this space is ICICI Prudential. They have been a part of our model portfolio for quite some time. Last 5 years, we have seen that. They have maintained that consistency in managing this aggressive hybrid or asset allocation funds. So we really like that fund house a lot in this space.
Now, I did really want to talk about thematic because it's, it's always a flavor to talk about, and it is one of the largest categories that currently exists in the equity category. Amol, the question is, how do you choose? Because you have to be right both when you enter and when you exit, because sometimes a sector can fall out of favor very, very quickly, and you're left with a bit of a concentration risk in that particular sector if you have too much of it. But at the same time, it can pay off really well. How do you choose one right now? And is an SIP approach the right way to invest in these schemes?
Well, Alex, I'm afraid I have to, my views have not changed since the time we spoke last, and maybe several other iterations of programs over all these years. First and foremost, what you have asked is whether this is the right time to choose a theme. My answer is, and we are on the MF corner, we are on the MF show. We are talking about a lay investor investing into mutual funds, and that investor has come to mutual funds because that investor cannot pick and choose stocks, cannot do the timing, or doesn't want to do. Even if you are skilled enough to do it, you don't want to do it because of certain regulations that your job might have, restrictions that your job might have, or you simply do not have time for it. Now, for such an investor, my stance is still the same. If you have to ask about a theme, then you should not invest in a theme. right? So that's what we have discussed earlier in the past, earlier as well. Second point is about whether via SIP is the right way to invest into theme or a sector. I would say, see how, and you have also touched upon it. A sector or a theme is particularly sensitive to various dynamics or macro factors. Those could be government regulations, those could be technological disruptions, those could be innovations taking place in various segments of that market. Now, I would say is if you want to pick and choose a theme and invest, instead of SIPs, do it via lump sum. Why? Because SIP, to have a meaningful allocation, you will take a lot of time, maybe 6 months, maybe 1.5, 2 years, to get a meaningful allocation into a particular theme. And by that time, this theme would have played out the way you are expecting. So I would say lump sum is probably the better way to go with it. But always remember, if you have to ask about thematic, then you should not invest into a thematic. A diversified fund, if you think that manufacturing theme will do well, just as an example, if that is the case, and if fund manager's view is aligned with your view, then a particular diversified scheme can buy stocks from the manufacturing theme or from any other theme for that matter.
Fair point. The last topic that I want to discuss today is a development from yesterday, Himanshu, and that has to do with fund of funds investing in overseas ETFs, which have hit, according to AMFI, 95% of the limit that has been prescribed by the Reserve Bank of India. That further limits what investors can put money in when it comes to grabbing a slice of overseas equities. So what are the options available right now, according to you? And should they continue to invest in these assets? You're talking about a NASDAQ that continues to test new highs every day.
Right. So again, over there, like today, a lot of people are saying, I am a great believer of India, but I also want to manage my risk, which means all my eggs into India is not the best of strategies. So for that, international investments becomes extremely important. For retail investors, this feeder funds actually was making a lot of sense, but now this limit has been achieved. Maybe everyone will wait for the government agencies or the regulators to enhance this limit, and then they can start systematically building it up over there. Again, over there, as you mentioned, markets have run up. If tomorrow the limit gets enhanced, one should go and systematically build up the portfolio over there rather than doing lump sum purchases. But for HNIs or UHNIs, there are other options which are available. Let's say under LRS, one can actually do USD $50,000 per annum. So new financial year is coming up. New limits will also open up for each and every HNI. So they can actually look at those vehicles to build their overseas portfolio. And over there also, I would say if someone has to build up an equity portfolio, do systematically. But our recommendation in our model portfolio for international, it's a very, very broad, diversified portfolio which we have created across multiple asset classes, multiple geographies, right, and across active and passive strategies. Then there is also another interesting route which is evolving, and practically everyone is talking about it. Very few have implemented it. It's the gift city route,
right,
which has also opened up. So a lot of family offices are thinking of creating an entity and looking at parking a part of that, like 50% of that is allowed to be invested in the international markets. I'm sure as things evolve, there will be far more options or sophisticated options which will be available over there. So
and we'll talk about, and I think you spelled it out quite well, Himanshu, and we'll talk about that. I think it warrants a separate show to talk about the various options available and what will develop there. But thank you so much, both of you, for taking the time and for speaking to us on the Mutual Fund Show. And to you, viewer, hopefully the various topics that we've had on this particular program have benefited you. If you've got questions for us, you can send them to us on the WhatsApp number on your screen. And meanwhile, do stay tuned. Lots more coming up on NDTV Profit.